about getting started with technical analysis, and we brought up a story that exemplifies and explains all of this. So let's continue with that next page, please. Now, we are looking at forecasting tools, and there is a story about a speculator whose desire was to be a winner was intensified by each successive failures, and he tried fundamental analysis, chart analysis, computerized trading systems, and even a number of esoteric techniques ranging from wave counting to astrology. And although each of these approaches seemed to work well on paper, once he started to place actual trades based on these methods, an odd thing happened. His short positions inevitably seemed to be followed by towering bull markets and steady uptrends, which had an uncanny tendency to reverse course after he went long. So, after years of frustration, he finally gave up in exasperation. Next page, please. It was at this point that he heard of a famous guru who lived on a remote mountain in the Himalayas and who answered the questions of all pilgrims who sought him out. Now, the trader boarded a plane to Nepal, hired guides, and set out on a 2-month trek. Finally, completely exhausted, he reached the famous guru. So, oh, wise one, he said, I am a frustrated man. For many years, I have sought the key to successful trading, but everything I have tried has peremptorily failed. What is the secret? Now, the guru paused for only a moment and, staring at his visitor intently, answered, Blash. He said no more, Blash. The trader returned home. He did not understand the answer. It filled his mind every damn day, waking moment, but he could not, figure or phantom it out. Right? Next page. He read the story to others until finally one listener interpreted the guru's response. It's quite simple. He said, buy low and sell high. That's the meaning of Blash. And the guru's message is apt to disappoint readers seeking the key to trading wisdom. Blash does not satisfy our concept of an insight, right? Because it appears to be a matter of common sense. However, if, as Voltaire suggested, common sense is not so common, because neither is it obvious. For example, you consider the following questions. What are the trading implications of a market reaching new highs? The common sense Blash theory would unambiguously indicate that subsequent trading activity should be confined to the short side. Very understanding, of course, should be confined to the short side. Next page, please. So very likely a large percentage of speculators would be comfortable with this interpretation. Perhaps the appeal of the Black approach is to the desire of most to demonstrate their brilliance. And after all, any fool can buy the market after a long uptrend, but it takes geniuses to fade the trend and pick a top with this. So in any case, few trading responses are as instinctive and as the bias toward buying when prices are low and selling when the prices are high. So as a result, we have many speculators that have a strong prediction towards favoring the short side when a market trades at new high levels. So there is only one thing wrong with this approach. It doesn't work. Why? Because the market's ability to reach and sustain new highs is usually evidence of powerful underlying forces that often push prices much more higher. So in common sense, certainly, but note that the trading implications are exactly opposite to those of the common sense, which is, of course, the Blash approach, right? Next, please. So the point of all of this is many of us, of our common sense instinct about market behavior are wrong. We have chart analysis, which provides a means of acquiring common sense in trading, and it go for more elusive than it sounds. For example, if prior to beginning trading and the individual exhaustively researched historical price charts to determine the consequence of a market reaching new highs, he or she would have a strong advantage in avoiding one of the common pitfalls that await the novice trader. So similarly, other market truths can be gleaned through a careful study of historical price patterns, and it must be not acknowledged, of course, because however, the usefulness of charts as an indicator of future price direction must be a fiercely contested subject, because rather than list the pros and cons of the argument, we know that a recent episode of a popular TV series on the financial markets succinctly highlighted some of the key issues in this debate. Okay, next page, please. We have the moderator, and we have Professor Coin. Let's just say, for instance, we have the likes of Wall Street, Louis Pinesa of Wall Street Week, and a current professor at Ivory Tower University, and they are all looking for some sort of hiking club that decides its destinations by throwing darts at a trail map. So this, of course, will smile smugly into the camera. Why we talk of Professor Coin? Because Mr. Coin said the random walkers are a group of economists who believe that market price movements are quite random, but all the same, we have both events which are strictly a matter of chance. Prices have no memory, and what happened yesterday has nothing to do with what will happen tomorrow. In other words, charts can only tell you what has happened in the past. They are useless in predicting the future. Next page, please. So we have this small channel communication between these two. So next page, please. Next page. Next page. Next page. Next page. Next page. Next page. Now, in the sense, the random between the two of them are the chartists can never clearly solve, because it must be understood that it is impossible to provide or prove randomness. All that one can prove is that a given pattern does not exist, because there is no consensus as to the precise mathematical definition of many chart patterns. The viability of these patterns as price indicators can neither be proven nor disproven. So, for example, if one wanted to determine if breakouts from trading ranges represent valid trades signals, the first requirement would be to formulate a concise definition of a trade range, and the breakouts assume that the following definitions are adopted: that the trading range is a price band that completely encloses all daily prices changes during the past 6-week period, and that is no wider than 5% of the median price during that period. And two, that a breakout is a closing price above the 6-week trading range. Next page, please. So some of the objections might include the following: one, the price band is too narrow; two, the price band is too wide; three, the 6-week period is too long; four, the 6-week period is too short. So no allowance is made for isolated days beyond the confines of the range, and an event that most chart analysts would agree does not disturb the basic pattern. So the direction of the trend prior to the trading range is not considered a factor that many chartists would view as a critical input in interpreting the reliability of a breakout. Then 7 would be the breakout should be required to exceed the boundary of the trading rate by a minimum amount, for example, 1% of the price level, in order to be viewed as valid. And while number 8 would be several closes above the trading range should be required to indicate a breakout. And number 9 would be a time lag should be used to test the validity of the breakout. For example, Our price is still beyond the trading range 1 week after the initial penetration of that range, right? Next page, please. So the preceding lists represent only a sample of the possible objections to our hypothetical definitions of a trading range and a breakout. And all of these for one of the most basic chart patterns. Imagine the ambiguities and complications in specifically defining a pattern such as a confirmed head and shoulders. For the other part, the chartist cannot win the argument either, because although chart analysis is based on general principles, its application depends on individual interpretation. Successful chart-oriented trader might not have any doubts about the viability of chart analysis, but the random walk theoreticians would dismiss the charter's success as a consequence of the laws of probability. Why? Since even a totally random trade selection process would yield a percentage of winners, of course. And in short, the debate is not about to be concluded because it still goes on and on and on. Next page, please. So, of course, it is always also important to realize that even if conclusive tests were possible, the conflicting claims of the random walkers and the chartists need not necessarily be contradictory, because one way of viewing the situation is that markets may witness extended periods of random fluctuation interspersed with shorter periods of non-random behavior. Thus, even if the price series as a whole appears random, it is entirely possible that there are periods within the data that exhibit definite patterns, and the goal of the chart analyst is to identify those periods, which are the major trends. And the time has come to admit my own biases. Personal experience has convinced me that charts are a valuable, if not essential, trading tool. However, such perceptions do not prove anything. The random walkers would argue that my conclusions could be based on selective memory, that is, a tendency to remember the successes of chart analysis and forget the failures, or just pure luck. And they are right, because such explanations could indeed be in a way very correct. Could be in a way very correct. So next page, please. So much like each trader must evaluate chart analysis independently and draw his or her own conclusions. However, it should be strongly emphasized that charts are considered to be an extremely valuable trading tool by many successful traders, and therefore the new trader should be wary of rejecting this approach simply on the basis of intuitive skepticism. Some of the principal potential benefits of using charts are listed below, and we know that a number of these uses remain valid even if one totally rejects the possibility that charts can be used to forecast prices. Number one, charts provide a concise price history and essential items of information for any trader. Right? Two, charts can provide a trader with a good sense of the market's volatility, an important consideration in assessing risk. Three, charts are a very useful tool to the fundamental analyst, and for long-term price charts enable the fundamentalist to isolate quickly the periods of major price moves by determining the fundamental conditions or events that were peculiar to those periods. And the fundamentalist can identify the key price influencing factors, and this, of course, information can then be used to construct a price behavior model. Next page, please. Now, charts can be used as a money management tool by helping to define meaningful and realistic stop points. We have charts reflect market behavior that is subject to certain repetitive patterns, given sufficient experience. Some traders will uncover an innate ability to use charts successfully as a method of anticipating price moves. While an understanding of chart concepts is probably an essential prerequisite for developing profitable technical trading systems and decisions, And of course, we have cynics that take notice under specific circumstances. A contrarian approach to classical chart signals can lead to very profitable trading opportunities. And the specifics of this approach are detailed in chapter 11, which will be coming up later in the series. And in short, charts have something to offer everyone, from cynics to believers. The chapters on this section review and evaluate the key concepts of classical chart theory, as well as address the all-important questions of how charts can be used as an effective trading tool. Next page, please. We have types of charts. The price chart, of course, is the primary tool of the technical analysts, although there are a variety of formats. Most charts use a grid system in which the x-axis measures time while the y-axis measures price level. The time increment of the x-axis can vary according to the longer or shorter term perspective of the analyst. We have charts can be constructed using price data for any interval, yearly, monthly, weekly, daily, name it. And the most common on intraday, e.g., we have 60 minutes, 30 minutes, etc. Like that. Next, please. So that's all for today on our series, and we have gotten a little hang on folklore as well as types of charts, and we should be ready for next week, what it holds for us as we push on to more and more about technical analysis on the Forex charts. So thanks guys for joining us today, and see you again next week.